In the nascent dawn of the digital age, a revolution was brewing, not in the streets, but in the server rooms and the minds of visionaries. Data was the new oil, and someone had to build the refineries. Enter Richard Egan and Roger Marino. In 1979, they founded EMC, not with a bang, but with a quiet determination to solve a problem few even understood: how to store the ever-expanding universe of digital information. Their initial focus was on memory boards, a crucial component for the burgeoning mini-computer market. It was a niche, but a vital one, and they approached it with an engineer's precision and an entrepreneur's fire. This was the bedrock upon which a future empire would be built, brick by digital brick. The early 1980s were a time of seismic shifts in computing. Mini-computers gave way to workstations, and the demand for faster, more efficient ways to access and manage data exploded. EMC, under Egan's leadership, pivoted. They saw the limitations of existing storage solutions and envisioned something bolder. Their innovation? The Symmetrix Direct Access Storage System. This wasn't just an incremental improvement, it was a paradigm shift. It offered unprecedented speed, reliability, and capacity, becoming the gold standard for enterprises that couldn't afford to lose a single byte of critical information. This was the moment EMC began to define the future of enterprise storage. The Symmetrix was a marvel, but its success was not guaranteed. It required a significant leap of faith from customers. These were large corporations, entrusting their most vital digital assets to a relatively young company. EMC sales team faced skeptical IT departments accustomed to established, albeit less capable, solutions. They had to educate, to demonstrate, to convince. The sales process was long, arduous, and depended heavily on building trust. Each deal closed was a victory, a testament to the product's undeniable superiority and the relentless drive of their sales force. The 1990s roared in, and with it, the internet. This seismic shift presented both an opportunity and a threat. Suddenly, the amount of data being generated was skyrocketing. Businesses needed to store it, manage it, and access it faster than ever before. EMC was perfectly positioned to capitalize. Their Symmetrix systems became indispensable. Revenue soared, profits multiplied, and EMC transformed from a niche player into a dominant force in enterprise storage. They were no longer just selling hardware, they were selling the backbone of the digital economy, and the market couldn't get enough. By the late 1990s, EMC was a powerhouse, a darling of Wall Street. Its stock price climbed relentlessly, rewarding investors and fueling further innovation. Richard Egan, the pragmatic engineer, and Roger Marino, the shrewd businessman, had built something extraordinary. They understood that storage was not just a cost center for businesses, but a strategic asset. Their focus on high-end, high-performance systems created a moat around their business, making it difficult for competitors to challenge their dominance. The company's success was a testament to their vision and their ability to execute. The dot-com bubble was inflating, and EMC was at its heart, albeit in the less glamorous, but far more essential, world of infrastructure. While other companies chased ephemeral online dreams, EMC was building the very foundation upon which those dreams would live or die. Their focus on enterprise-grade solutions meant they were dealing with the real needs of established businesses, not just speculative ventures. This grounded approach, however, didn't prevent their valuation from soaring to astronomical heights, fueled by the broader market exuberance. They were a tech titan, indispensable and seemingly invincible. The year 2000 arrived, and with it, the inevitable bursting of the dot-com bubble. The market correction was brutal. Companies that had inflated their worth on pure speculation collapsed overnight. But EMC, though not immune, possessed a crucial advantage: real revenue, real profits, and a product that businesses absolutely needed. Their infrastructure was the engine room of the digital economy. While the speculative frenzy died down, the need for reliable data storage only grew. This resilience allowed EMC to weather the storm, emerging stronger as many of its rivals faltered. Amidst the post-bubble consolidation, a new leader emerged within EMC, Joe Tucci. He took the helm in 2001, inheriting a company that had proven its mettle but now faced a rapidly evolving landscape. The rise of virtualization and the increasing complexity of IT environments demanded new solutions. Tucci, a seasoned executive with a reputation for strategic acumen, understood that EMC couldn't rest on its Cimetrix laurels. The company needed to expand its offerings to become a more comprehensive provider of information infrastructure. This was the beginning of a new era of ambition and strategic repositioning. Tucci's strategy was aggressive. He recognized that to truly dominate the information infrastructure market, EMC needed to integrate a wider range of technologies. This meant acquisitions. He began orchestrating a series of strategic purchases, bringing companies specializing in storage networking, backup software, and other critical components under the EMC umbrella. This wasn't just about buying market share, it was about building a unified, end-to-end solution for enterprises. Each acquisition was a calculated step, carefully chosen to complement existing strengths and fill emerging gaps in the market. One acquisition, in particular, would redefine EMC and its place in the tech world: VMware. In 2003, EMC acquired a majority stake in the nascent virtualization software company. This move was prescient, bordering on prophetic. Virtualization allowed companies to run multiple operating systems and applications on a single physical server, drastically reducing hardware costs and increasing efficiency. EMC, by owning a significant piece of VMware, positioned itself at the forefront of this transformative technology, integrating its storage solutions with the virtualized environments that were rapidly becoming the industry standard. The VMware investment proved to be a masterstroke. As virtualization took hold, EMC's value proposition became even stronger. Businesses needed robust storage to support their virtualized infrastructure, and EMC provided it, coupled with the leading virtualization software. This synergy propelled EMC to new heights. The company's market capitalization swelled, its influence expanded, and it became a cornerstone of the enterprise IT landscape. Tucci's strategic vision had transformed EMC into a diversified information infrastructure powerhouse, far beyond its origins in memory boards. Yet, even at its zenith, the tech industry is a relentless tide. The rise of cloud computing began to challenge the traditional on-premises model that EMC dominated. Companies started exploring off-premises storage solutions, where data was managed by third-party providers. This presented a fundamental threat to EMC's core business. While EMC offered cloud-ready solutions, the allure of scalable, pay-as-you-go cloud services began to erode the appeal of massive, upfront investments in hardware. The ground was shifting beneath their feet, subtly at first, then with increasing urgency. The challenge intensified with the rise of hyper-converged infrastructure, which integrated compute, storage, and networking into a single, software-defined platform. Companies like Nutanix began to offer solutions that were simpler, more agile, and often more cost-effective for certain workloads than EMC's traditional approach. EMC, despite its acquisitions and innovations, found itself in a position where its established strengths were becoming its weaknesses. The company had to adapt, and adapt quickly, to remain relevant in this rapidly evolving ecosystem. The market was demanding a new kind of IT infrastructure. It was in this climate of evolving technology and increasing competition that Michael Dell, the founder of Dell Technologies, saw an opportunity. Dell, a giant in PC manufacturing and enterprise solutions, was looking to expand its footprint in the storage and data center market. He had his eyes on EMC, recognizing its immense value, its loyal customer base, and its critical intellectual property. A potential merger or acquisition would create an undisputed behemoth in the enterprise IT space, capable of competing across the entire technology stack. Negotiations began, shrouded in secrecy. The scale of such a deal was unprecedented. A merger between Dell and EMC was estimated to be worth upwards of $60 billion, a staggering sum that dwarfed most previous tech acquisitions. For Dell, it was a bold, transformative move to pivot from a PC-centric company to a comprehensive enterprise solutions provider. For EMC, it represented a potential endgame, a way to consolidate its position and provide a significant return to shareholders, while also navigating the complex future of IT infrastructure. The stakes couldn't have been higher. The path to closing the deal was fraught with challenges. Regulatory hurdles, shareholder approvals, and the sheer complexity of integrating two massive, distinct corporate cultures loomed large. There were moments when the deal appeared on the brink of collapse. The financial engineering required to structure such a transaction was immense, involving complex debt financing and the careful handling of EMC's significant stake in VMware. Every detail had to be meticulously planned and executed to ensure the deal's success. The crucial element, however, was EMC's ownership of VMware. Dell wanted EMC, but EMC's true value was inextricably linked to its substantial stake in VMware, the virtualization giant. The structure of the deal had to account for this. Instead of a straightforward acquisition, a unique reverse merger was devised. EMC shareholders would receive cash and stock in Dell, while EMC itself would effectively be absorbed into Dell. This complex financial maneuver was designed to unlock the value of both companies, particularly the VMware stake, which would eventually be spun off separately. Finally, after months of intense negotiation and intricate financial structuring, the deal was done. In 2016, Dell completed its acquisition of EMC for approximately $67 billion, creating Dell Technologies. It was the largest tech acquisition in history at that point. The combined entity promised a comprehensive portfolio, from PCs to enterprise servers, storage, networking, and security. Michael Dell declared it a new era for technology, one that would empower customers to build, transform, and accelerate their digital futures. The ambition was immense, the potential game-changing. The integration was a monumental undertaking. Merging two distinct corporate cultures, consolidating product lines, and streamlining operations across such a vast enterprise presented enormous challenges. While the acquisition promised synergies, the reality of execution proved complex. Dell Technologies had to navigate the evolving market dynamics, particularly the ongoing shift towards cloud computing and software-defined infrastructure, while managing the integration of its newly acquired assets. The sheer size of the combined entity created inertia, making rapid adaptation more difficult. The impact on EMC's original vision was profound. While the brand name eventually receded, its core technologies and intellectual property became integral to Dell Technologies' broader strategy. The spirit of innovation that defined EMC, particularly in enterprise storage, was now channeled through a larger, more diversified entity. However, the market continued its relentless march. The rise of hyperscale cloud providers like Amazon Web Services, Microsoft Azure, and Google Cloud began to fundamentally alter the enterprise IT landscape, offering increasingly powerful and cost-effective alternatives to traditional on-premises solutions. This presented an ongoing challenge for the integrated company. Joe Tucci, who had orchestrated the monumental merger, eventually retired. Michael Dell, however, remained at the helm, guiding Dell Technologies through the complexities of the post-acquisition era. The company continued to evolve, focusing on areas like hybrid cloud, edge computing, and artificial intelligence. While the EMC name faded, its legacy lived on in the robust storage solutions and enterprise infrastructure that formed a critical part of Dell Technologies' offerings. The ambition to provide comprehensive IT solutions, born from the EMC acquisition, continued to drive the company forward. The EMC story is a powerful illustration of the cyclical nature of the tech industry. What was once a revolutionary, market-defining innovation can, over time, become a legacy product facing new paradigms. EMC built an empire on the promise of enterprise storage, becoming indispensable. Then, through strategic acquisitions and visionary leadership, it expanded into a comprehensive information infrastructure giant. The ultimate merger with Dell was a testament to its enduring value and a recognition of the shifting market forces. the ambition that fueled its rise was undeniable. The tale of EMC's journey, from its humble beginnings to its integration into Dell Technologies, underscores a fundamental truth about business and technology. Innovation is relentless, and adaptation is survival. The company's ability to foresee market needs, to innovate, and to strategically acquire key technologies allowed it to thrive for decades. However, even the most dominant players must contend with disruptive forces. The rise of cloud computing and new infrastructure models ultimately reshaped the landscape, leading to the transformative decision to merge. The $67 billion acquisition by Dell was not a sign of failure, but a strategic pivot. It was a bet that combining EMC's enterprise strength with Dell's broader portfolio and scale could create a formidable force capable of navigating the future of IT. The psychology of such a massive deal is complex: ambition, legacy, shareholder value, and the sheer audacity of trying to build the ultimate enterprise technology company. It was a move born from a deep understanding of the market, but also from an immense appetite for growth and consolidation in a rapidly changing world. The story of EMC serves as a potent reminder that even empires built on bedrock innovation are not immune to the tides of change. Their ability to dominate the storage market for so long was a testament to strategic foresight and relentless execution. Yet, the relentless march of technology, particularly the seismic shift towards cloud computing, created pressures that no single company could entirely resist. The decision to merge with Dell was not a surrender, but a strategic evolution, an attempt to harness scale and synergy to face a new era. The ambition to remain at the forefront defined their final chapter. Ultimately, EMC's journey from a small startup to a cornerstone of a tech behemoth, and its eventual integration, highlights a critical lesson about ambition and adaptation. The market's relentless evolution demands constant reinvention. If you found yourself weighing the immense risks and rewards of that $67 billion bet, hit the like button and subscribe if you want to see more stories about the pivotal moments that shape fortunes. This video required poring over hundreds of financial filings and decades of market analysis.